We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. We're back in the studio with Arie van Gemeren. I didn't even have to read it that time. I memorized it now. Can you believe that?
I can believe
even
it.
Even a little brain like me can figure out your last name. Arie, you're the founder and CEO of Lombard Equity Group. We want to dig in. Dane had to leave to go raise some money, so it's just me and Mike. We're gonna sit here and have some intimate time. We want to talk about deals.
We're going to talk.
Are you ready for this?
Operations and not finance.
I'm ready.
We'd really love to hear about pain.
I want to know why you came up with Lombard. Anyone from Portland knows, like, why did you name
Lombard
your name
Street.
after Lombard Street?
Well, it's a funny
Or is
story.
that you're from San Francisco?
I'm
It's
from
a different
San
Lombard
Francisco.
Street.
Different Lombard,
Different
yeah.
Lombard Street.
So the stated story is the squiggly street in San Francisco, right?
Yeah.
The actual story is when I first started, I was like, what am I going to name this business? And I was like, what's a name that sounds prestigious and cool? And Lombard Equities Group was what came out of it.
Okay.
So that's the long and short of it. But then people from Portland were like, why would you pick Lombard? Exactly. I was like, I'm not from here. I think I'm
San Francisco.
Beautiful San Francisco street
Yeah.
or the Lombard region of Italy. Don't think about that street.
Sounds better than Cooch Equities, I think.
That's true. We won't even get into this story about my friend Botero with... I won't say the word.
All right, so this is our deal episode. You can speak in depth or as transparent as you want to be, but we want to hear about probably a really bad deal, maybe something where things went wrong. You talked a little bit about a cash-in refi on the last one, and then maybe a really fun deal and something you really like. So you could start either way. You want to talk about something that gives you pain, or do you want to start off with something that's really fun?
Let's start with pain.
Okay.
I feel like let's
All right.
let's
just get it out of the way.
Band-Aid off this.
Yeah.
thing.
Yeah.
So, I think some of the worst deals we've done have been in Oakland, California.
Oakland. Okay.
So there's so much to learn from these examples, right? So we bought a 15-unit building in Oakland, and it's an ongoing deal. We're still in it. It's actually doing fine right now, but it's a painful experience for us. So we've had a thesis since we started, this contrarian thesis. We're going to invest in deep blue urban core locations, deep blue states, and we're going to kind of hold to our guns. And so when we started buying in Oakland was already on a decline, on a pretty strong decline. And our thesis was that we were at or near the bottom and things were going to get better. And that the broader thesis on the West Coast was that the overreaction to the West Coast was overblown.
Mm-hmm.
And money was going to eventually come back. And Oakland had been this fantastic market. It's kind of like the Brooklyn to Manhattan. It is very reliant on San Francisco. And so we bought a deal, which seemed like great pricing at the time. We bought it when the market was already starting to decline. And it was a classic value add deal. So we were going to go through, we're going to renovate units, we're going to improve the rents. And that was the business plan. And we executed the business plan. We did a good job with the business plan. But a lot of things happened in the course of that project. I mean, first of all, it was a 3-year. I mentioned before I don't like 3-year bridge debt. This was a 3-year bridge debt style deal, which was a mistake in hindsight for a variety of reasons. One of which is that in a very, very heavily rent-controlled market, very anti-landlord market, 3 years is really not enough time to execute your business plan, A. B, as I said before, you don't know what the market will look like in 3 years' time, right? And unfortunately for us, the Oakland market has steadily degraded in that time. It has not gotten better. So rents have actually gone down. But the thing that makes the deal stand out to me is we mispriced or misjudged political risk in the market, which is an interesting comment because we're still actively investing in Portland. We're still actively investing in Seattle. But I've always felt like the Bay Area was the most egregious form of like far left housing politics on the West Coast, much worse than these other markets. So Portland and Seattle are like the junior varsity league of like far left.
You weren't around when Chloe U. Daly was in head of Portland.
No, I wasn't. But it cannot be worse than the Bay Area.
Yeah.
I mean, no matter what, as an operator in Portland, it's a lot easier to manage than it is in the Bay Area. Mm-hmm. And so a quick sequence of events happened that were really, really brutal in Oakland. So let's put aside the fact that like the homeless situation in Oakland was comparably bad to Portland. and that Oakland actually successfully defunded their police force. So you couldn't get quality police officers to work in Oakland. So calls for crime went unanswered. Minor larceny and like break-ins and all this stuff was constant, right? So you had a resident flight from the city. We sort of misjudged, well, not sort of, we misjudged the extent to which Oakland was reliant upon San Francisco to be prosperous. So Oakland is not as great a city as San Francisco, hard stop. And it was very levered to like, what does San Francisco do? Oakland becomes an interesting market. In some ways, I think analogous to Brooklyn to Manhattan. It becomes an interesting market when San Francisco gets too expensive. And then you're like, okay, I can go to Oakland and still get into SF and enjoy life, but it's, 60, 70% the cost to live in Oakland. And we bought in a neighborhood that's probably like the nicest neighborhood in Oakland. There's a really beautiful lake in downtown Oakland called Lake Merritt. And right north of it, there's a community called Adams Point. Adams Point looks and feels like a San Francisco neighborhood. It's a beautiful neighborhood. And it has a steadily reducing supply of housing because they're constantly converting the housing into condos, or they're combining units to like make bigger units. So if you look at the long-term track record of Adams Point, there's a steady reduction in supply, which is like our bread and butter, right? We like the markets where it's hard to build, where you can't do anything. What was misjudged was the degradation of the ground game there, right? The degradation of local politics and the fact that San Francisco took quite a while to recover. It is now recovering. So I think there's an end zone in sight for us with Oakland as well. But you had population flight from downtown Oakland. Just is what it is, right? And like many of these West Coast cities, downtowns haven't really recovered. So that was the macro, right? So there's a macro thematic going on. There's a micro issue within Oakland at the same time. And then you have interest rates, right? So obviously interest rates have gone up dramatically in this time since when we bought to today. From a micro standpoint, what we misjudged politically was the extent to which there was so much antipathy from electeds in the city towards the ownership class, the ownership group in the city, right? So I'll give you some examples. So the Bay Area has really restrictive rent control. It makes Oregon and Washington rent control look like a joke. It's 2/3 of Bay Area CPI. However, when we first bought the building, inflation had just ripped. So we were actually entitled to make around a 6.8% rent increase, which we had built into our model. That was our plan. This is allowed. We're going to make this increase. The first thing that happened is the Oakland City Council called an emergency meeting, and they said, never mind. I know this has been the rule for 20 years.
No bumps.
It's not the rule anymore. We're changing the rule. Now it's 2% or 2/3 of Bay Area CPI, whichever's lower. That's what you're allowed to increase. So right out the gate, we closed. This meeting happened maybe 2 months after we closed. They completely changed the rules. Painful. Not anticipated. Very difficult to build a long-term investment plan when the city can just so casually destroy your investment thesis, right?
And the ownership class is a much smaller group than the tenant class. So
Always.
Where's your voice?
There's no voice. And there's a lot of people fighting the good fight in the court system. So we'll see what happens. But this is this is a broader story about far left housing politics and owners and what's happening, right? But it's definitely a vote winner to eviscerate or crucify owners and then protect residents, right? Arguably, I think the irony of the whole thing is I think it's actually perversely worse for residents in the long run, because I've always viewed real estate investing as like the force. Okay, hold with the analogy for a second. It's everywhere. Capital needs to flow freely through cities to refurbish and rebuild the housing stock. The government's not going to do it. And if you go to cities where they make it hard to be an owner and they make it hard to deploy money and they tax the hell out of you for everything, you'll notice a degradation of the housing stock. Like the buildings are starting to fall apart because owners can't even afford to invest in their own properties, right? And Oakland, Berkeley, all these cities in the Bay Area are great examples of this because they make it so difficult. They have very restrictive rent control. You can't get people out. So I think it's it's a short-term extractionary economics for the city, but in the long term, it's a really bad decision. And it's going to start biting them badly because property values are down dramatically and their tax revenue is going to start dropping. So you almost wonder if you're walking into this like doom loop where they can't even afford what they want to do because revenues are down. And office property tax revenue is down too. So but anyways, so that's the first hammer to fall. The next one was Oakland decided unilaterally to say you can't do RUBS anymore, straight up. You just cannot charge utilities back to residents at all. and they didn't tell anyone this. They just did it in a really secretive way, and then some astute residents would call the rent board, and they'd be like, "Well, my landlord's charging me RUBS," and it's written in their lease, and they signed the lease saying they could charge RUBS, and for 30 years we've been able to charge RUBS with no problem. And they were like, "Oh yeah, they can't do that." So we received a lawsuit from a resident that was like, "Hey," and he moved in. He was an attorney. He moved in, and 3 months later he sued us, and he's like, "You can't charge me RUBS," and we're like, "What do you mean we can't charge you RUBS?" It's like, "Well, go ask the rent board." So we went and asked the rent board, and they're like, "Yeah, he's right. You can't charge RUBS." So
that's how you found out?
That's how we found out. And we think, I suspect the goal was to cause as much collateral damage for owners as possible by not clearly choreographing the change in plan. So overnight, you lose $20,000 of NOI because you can no longer bill back utilities. The only way they'll let you bill back utilities is put in smart water meter systems, which is a fairly big project on these older buildings. But the majority of our utility cost is trash. It's not water, and you cannot bill trash back to the residents. So now they're like, you can only just charge rent. So you have to try to calculate, like, what is my rent amount? What is the rent amount that gets me back to where I was before? And I think my finding at this point, the short answer is, like, you're not able to work that number out because you're just competing with what everyone else offers for rent. So really, you just lost $20,000 of NOI from fees that residents were already used to paying anyways. They were already accustomed to paying for utilities. But the city blew that up. So that was like the second shoe to fall, right? And then the third one is they made evictions incredibly difficult. So if, and this was like, this didn't affect us as much, but Oakland had a lot of people left over from COVID that just didn't pay. And the city extended their COVID emergency period aggressively past the point that COVID was done, and this was a viable reason for people not to pay rent anymore. So there's like real economic loss, real monetary loss for these buildings. And then on top of that, there's the macro. And then consider what it does to investors' mindset about buying in Oakland. Nobody wants to buy in Oakland. So there's this suction of capital.
It's a pariah.
Yeah, suction of capital coming out of the market. It's impossible to sell buildings unless they're sold at a extremely good deal, which is usually a terrible deal for us and our investors. So in this particular case, we were able to refinance with Chase. Chase gave us Chase is one of the top lenders in my opinion right now. They're back in the market. I'm sure you guys remember.
Great to work with.
Period of time where they stopped lending.
Yeah.
Which was super annoying at the time. But in hindsight, they basically missed all of the excess lending.
They were smart.
They stopped lending, and now they've completely reopened the gates, and they're lending. And we've been using Chase on a lot of stuff. I mean, they're fantastic and cheap and easy to close with. So we ended up refinancing the deal, and we had to do a capital call, and investors had to contribute money. And the argument was we can either sell, and it's going to be a dramatic loss of equity for everyone, or we're going to hold through. We got a 7-year interest-only loan from Chase at a good interest rate. The building is cash flowing; it's stabilized. The pref equity are making a very healthy cash yield at this point, and we're like, we believe that San Francisco is coming back. It is coming back. I think they're at the last round, there were 17% year-over-year rent growth in the market. So SF is booming. Oakland is not going to be more than 1 to 2 years behind that. So the deal will be fine. But, and it's a difficult case study because our thesis is really built on investing in these contrarian locations. But how do you forecast?
Would you buy that deal today?
Today? At current pricing today?
Current state of the market.
I would buy in Oakland today.
Because you could get basis.
Yes, the basis is unbelievable right now.
Yeah.
Like I think you're got to be pretty close to the bottom. But I haven't really been looking because while the return might be there, managing property in the Bay Area is so difficult. It's so far above and beyond more difficult than
So from an operations standpoint?
From an operations standpoint, it's way more difficult.
I wanted to touch on the basis standpoint, and we didn't get to talk about it in the last one, but when you're raising capital in 20, 21, 22, there's no ability to buy on basis.
Right.
So when you look at that ratio of the capital stack, small percentage of it's going to down payment, and a lot of it's going to execute the business plan of terminating leases, relocation fees, CapEx, unit renovations, marketing, vacancy. Because everything's based on projection because you have to get to the back end yield to justify the acquisition. Whereas now the market's completely flip-flopped because demand's left Now you just get to buy a basis.
Right.
And now your capital stack can be mostly down payment. And so now that adds this level of security.
Right.
Because you don't have to execute a lot of vacancy and turnover and construction, and you don't have to achieve these rents that you think you can achieve. You're already achieving them. And so the ability to buy basis. So I wonder, like, you've been very finance heavy, and that's kind of your background, brought you into real estate through finance. And so now that you're a basis investor, I got to imagine that is a contrarian thought process to how you came into real estate.
Right.
So how does that change your mindset going forward?
Yeah, I mean, I think I'm pretty averse to doing value add deals right now.
Mm-hmm.
I think the time will come for them again. I just have existential concerns on pouring a lot of money into a building on the hope or even the firm. You know, I've actually, if I look across my portfolio, I've been really good. We've done a really good job of what we're going to get for rent post renovation.
Yeah.
Hey guys, Gabe here. Have you seen the exciting new projects we have going on at Stack Asset Group? If you're interested in investing with us, click the link in the description below.
But there's risk, right? Because like you still have to invest. You're either financing those renovations or you're having to funnel equity into those renovations. And I don't think, to me, I haven't looked at a lot of the traditional value add deal recently because the financing of it is expensive. So I don't really want to finance it. And then in my mind, it's like, okay, if we're pouring equity into the improvements, are you getting what you need out of it after the work is done? Versus like, I'd rather just own something solid and in good shape today that's going to produce a high cash yield, and then we just kind of wait for the market to come back. And I think it will come back. I know it will come back at some point. That's how real estate works. It's cyclical. We will come back to a point where things are exciting and money's sloshing around again. I think it's driven a lot by short-term rates. When financing renovations and improvements becomes palatable again for people, I think that'll be like the floodgates will start to open. Now, when does that happen? I don't know. 3 years, 4 years, 5 years, but that will come at some point. So yeah, I mean, I think it's funny you say like we weren't basis focused when we were buying. I mean, I always felt like I was relatively basis focused because we would look at the price per door versus like the market, and we'd be like, okay, we're well under the price per door for the market. But that price per door ended up being expensive compared to today. Like I obviously would have been, like we bought a deal in.
That price per door required appreciation in the fundamentals. It wasn't just fundamental.
Yeah. Yeah. Well, and I think we bought like a deal in downtown Portland in 24 at $140,000 a door. Mm-hmm. And I felt like that was a great basis. Like it was an old building. We could talk more about the kind of stuff we've been doing now, but it felt like it was a fantastic basis. And then fast forward 12 months and we're buying at $100,000 a door. Mm-hmm. So it's like, and it's sort of like, people talk about like with the stock market, like, so the market tanks. And do you wait for the bottom to get back in, or are you okay buying it down 30%, knowing there's another 15% decline, but like then you're going to get the bounce back?
Depends on your debt.
Yeah,
totally depends on your debt
and your investor mentality, right? Like,
yeah.
If you're a timeless investor and you're recruiting timeless mindsets,
Right.
Doing a capital call to refi is not that as difficult.
Right.
If you're an influencer with no experience and you've raised money from 35-year-olds that made money.
Yes.
And now you can't go get any more from them because it's throwing bad money after good.
Right.
Because that's the mindset versus, no, this is just a good investment. We're going to put more money into it. It's not performing how we want.
Right.
But ultimately, over time, it will accomplish our goals.
Exactly.
Yeah.
Yeah. Yeah. So I would say writ large, most California investments have not panned out very well for us.
So your contrarian thesis, you talked about deep blue, like that's still the same?
Yeah. I mean, I think I say this, yes, it is still the same. I think the thing that I've realized from the Oakland experience is that there is a wild card, which is
The political risk.
The political risk is a real wild card.
Because you could wake up one day and find out that you can't do rubs in Portland.
And that might happen because they watch what happens in the Bay Area.
Yeah, they just copy them.
That's interesting.
Yeah.
Yeah. So I think that's a real concern.
Absolutely.
If they wait long enough, though, and they see the effect like you're talking about, the degradation of the housing supply and that market falls apart, then you would hope there's some logic there where they go, maybe that's not a good idea.
You'd hope. But I've come to the conclusion that the rent control zealots and advocates are not they're anti-science.
Well, they're pro votes.
They're pro votes and they're anti-math and they're anti-science. They're like it's like a religious belief. You can't get them off of it. They're not going to come off of it, no matter what the contrary data is. They just believe in it, and I question if they believe in it because they want to protect renters or because they just want to hurt owners. And I think there's a healthy mix of both. I think
there is a healthy mix of both. Absolutely.
And to your point, they end up hurting the very person they're trying to help, right?
Well,
because it doesn't help anybody to have a degrading housing supply.
Yeah, that's why I refer to Chloe Eudaly, because the policy and her advisors were just, I don't like you. And so I just want to do the opposite of what you say, whether there's logic or not. That's tainting my opinion. It's a bias, right? It's a reverse bias process.
Yeah. There is on this note of just aiming to hurt owners, there is a organization in Seattle that is government funded, and it's a bunch of attorneys, and they float around looking for residents that are behind on their payments, very behind, in many cases like 6 to 9 months behind, and they haven't paid. And their purpose in life is to extend the amount of time they can stay in the building. And I truly don't believe the goal is to help the resident. I actually think their stated goal is to cause harm to owners instead, which is crazy.
So they're called tenant advocacy, but in reality, they're just
because they have so much leverage, and
owner.
They could use that leverage to really help the tenant.
They could,
but politically, it's better to use that leverage to hurt the homeowner or the owner to push advocacy or politics forward.
Yeah, it's crazy.
That's what I saw.
That's what I've seen.
Yeah.
So why the contrarian thesis? Because there's not as much competition in those markets. You're not going to see as many out-of-state investors. Is it just we get to play in our own backyard a little bit here and take advantage of it and just sort of go, hey, you're going to navigate some of this political risk as you see it coming?
Yeah, I think it's a multivariate piece. So. It's an easy sell to pitch red state, no regulation. This is the place to go, right? And a lot of money has flowed to those places. So to the first point, there is less competition, straight up. Like we don't deal with the same amount of competition on buildings here that we would deal with if we were buying in Texas, right, or Florida or one of these other markets. Blue states have a tendency to make it really hard to build. So they have a very inelastic supply function, meaning when population does increase, it's not easy to increase the supply at the same time. So I wrote an article a while ago about what does gold, Bitcoin, and real estate have in common. And you can actually, so there's a function in the Bitcoin community that's fascinating. It's the stock to flow ratio. So your stock is the amount of existing units of whatever you have available. The flow is how much you can add per year to the existing stock. Okay. So fiat currency, dollars, has like an infinite
amount,
because they can produce as much as they want. There's no barrier to producing more. Gold has a very historic, I don't know the exact number, but it has a very stable stock to flow ratio. It's difficult to mine gold. There's a lot of work and expense to bring it. So the gold stock is only slowly increased over time. Bitcoin has a fixed stock to flow ratio, which will eventually get to the point where there is no more flow because and that's the kind of the end goal of Bitcoin. But real estate has has similar mechanics, right? So you can look at different cities, and we actually did this analysis on the Timeless Investor, and it was, let me look at Manhattan, let me look at San Francisco, let me look at Portland, let me look at Austin, let me look at Miami, let me look at all these different major cities, and how many new units are being added to the stock every year, and kind of compare that to gold, to Bitcoin, to these other classic hard assets, right? Blue state cities are much more difficult to build in. So their stock to flow ratio is better for value preservation than in a really supply elastic market. So Arizona is a really good example. And I've spent years of my life during COVID arguing with investors about why I didn't think they should be buying in Arizona. But they were like, people love to go to Arizona because the population was booming, right? They're like, oh, population's booming. It's a red state. They're pro-business, whatever. But the supply function is super elastic. So they were able to build really quickly in reaction to that demand. And so what has happened? Rents have gone down dramatically in those markets. Austin rents are down like 20%. That has had a real impact. Blue state markets exhibit this dynamic where they don't have the boom and bust huge rent spikes and rent drop as much as the red state markets. They're a more stable glide path over time if you look over the long term of how these markets have performed.
More supply control.
way more supply control. And then you add like rent control into the equation, right? I'll give you another example in Portland, like the inclusionary zoning rules, right? I'm sure you guys are acquainted with it, but for the audience's benefit, I'll just dive into it. Portland said, I don't know the year, but they said
2019, I think, 18, 19.
If it's
anything over 20 units.
Anything over 20. And so what happened in the immediate aftermath?
Everyone built 19-unit complexes.
19-unit complexes, which means you're taking land that could have been a 50 to 100-unit building.
Yeah.
You built a 19
You shrunk the
instead.
supply.
So like it's so backwards to the goal to reduce housing prices. So we look at that and we're like, okay, we like that. The other thing I like about the markets we're in is, my wife calls it like we're like bridge and tunnel investors. Like I like cities that are geographically constrained. You can't just sprawl everywhere.
Yeah.
So from being from California, I never liked Sacramento because Sacramento you could sprawl, you could just keep building.
That's why I don't like Hillsborough.
Right, that's a concern.
Except the urban growth boundary.
Except the urban growth boundaries. But like Portland and the neighborhoods we invest in are literally boundaried by rivers and mountains. So that I still stick by the contrarian thesis. And I think the last piece of it is like there's a very deep amount of education, university ecosystems, and business in these markets that is not, I don't think is going to go anywhere, right? And like Portland is, I'm sure you guys just saw, but Oregon just topped the list for inbound migration, right? So like it's coming back. And it just seemed overblown, and so I'm going to stick to my guns on the thesis.
You overblown as far as the exodus?
The exodus thesis and the investment capital.
So we were both at the same HFO event yesterday.
Yes, we were there. Yep.
So we talked about the van lines on our last episode, and what we didn't have was the actual occupancy numbers, the data, the population changes with it. And he did. John Mitchell had a great slide on the actual change. And so the numbers behind that was net migration was like 11,000 people. That was 41,000 people immigrating here and 30,000 domestics leaving. So that's old data, but the van lines point to new data, which is the psychology change. And I just had that conversation last night. There was an event, networking event, someone moving back. Oh, I've got 5 friends that did the same thing that I did, that moved to a different state during COVID, and now we don't like it and we want to come back. Yeah. And so the psychology drives finance. Psychology drives demographics. Demographics drives everything. And what you're pointing to, which is what I love, is blue states make real estate unique and scarce.
Yes.
But what blue states also do is they don't keep the income levels down.
Right.
And so you have scarcity, and high incomes creates high value and floors to value.
Right.
So you're saying whether you like the politics or not, the politics that we have actually can be played to our benefit.
When you know how to operate.
If you know how to operate within it.
Yeah.
Well, if you're used to operating in a red state and you decide to come to the West Coast,
you're gonna get
you
your
might you might get your teeth kicked
If your
in.
only lens is through capital placement, it makes it very difficult to see how do you grow that capital.
Yeah. All right. Can we dig into a fun deal?
Sure. Yeah. Absolutely.
That's way more economics than deal. This is definitely a finance dude. We're going to get him onto the dark side.
Tell us about one of your favorite deals that you've done, where it was, why you love it.
Well, we did. So I mentioned we've been pursuing this basis play thesis for a while. So we just bought a deal in Seattle early last year. Fascinating closing process and acquisition process. We've had a really specific thesis, and reasonable minds can disagree on the thesis, of buying pre-war kind of vintage assets in downtown core locations. The thesis being they occupy great real estate because they were generally built when the city was being built, right? So they occupy like some prime location, right? There is a very thin market for them at the moment. Nobody is buying these things. Nobody. And so if you can build a reputation for closing them, figuring out how to handle the many difficulties there are with acquiring them, right? The financing, the insurance, the systems replacements, all the stuff that goes
plumbing, electrical,
all the concerns. There is real money there. And our thesis has been to acquire these, 1910 through 1940s buildings at a very good basis, kind of sit on them, collect a lot of cash flow, do whatever systematic upgrades we need to make over the life of the project, and wait. Because I do believe at some point rates come back down, bridge money comes back into vogue, money starts sloshing through, and then they start to look like good value add candidates, right? Like, let me go in and take this 1970s, 1980s style unit and improve it to like today's standards, and that market will come back eventually. So we bought a building in Capitol Hill in Seattle on that exact thesis. And, it was a beautiful property, 34-unit building, huge units. That's the other thing. It's funny, actually, on touring this building, we had one of the larger developers in Seattle ended up investing with us in the deal. And they walked the building with us. And the commentary was, man, the ceiling height clearance is great. Like, the ceilings are really high. And, oh, these units are huge. This is awesome. Like, they're so big. And it occurred to me in this vintage versus modern unit stuff, we're over-excelled today. Like when a developer builds a building today, it's like, how do I squeeze as much possible revenue out of every square foot?
The efficiency of it.
Yeah.
Efficiency.
Yeah.
So like I'm going to get the tightest ceiling height.
Because labor's tight.
Everything's tight.
Yeah.
So like I got to make it work. So I'm going to over-engineer the building to like pack as many rentable things into the building as possible.
Not thinking about livability.
Not thinking about
the
livability,
feeling
how
of
it
the
feels.
space. Yeah.
And it goes to explain why a lot of the new developments are all studios or very studio heavy because studios have the highest rent per square foot. Versus this building has no studios, and the smallest unit's like 650 square feet in Capitol Hill in downtown Seattle. So, replacement cost in Seattle to build a new unit is like $450,000. We bought this one for $195 a door, and every single unit rents for $2,400 plus a month.
That's a deal.
It's a great deal.
That's a great deal.
It's a great deal.
In a great area.
And it was an unbelievable deal. And I won't go in. I'm sure the brokers would be mad at me if I talked about the family
specifics,
dynamics behind how this thing got sold. But let's just say there was some intra-family fighting, fraud, and other issues.
Yep.
So the lawyer was selling it. The family was not
Oh, wow.
involved, which is amazing because they're also
Somebody
price agnostic.
detached from
Detached, they
the
don't-
emotionality of it.
Yeah.
They're just like, I don't want to get sued. I got to make sure the pricing is good. No, sorry. Not that the pricing is good. That I ran a fair process that resulted in a price that I can defend.
Yeah.
And we were the
That's a
best.
great
covering
way
his
to
own butt.
analyze that. A lot of attorneys that aren't, they think, right, has to do. No, you need to be able to defend yourself.
Yeah.
Yeah.
Yeah, there was the concern was not being sued. And we were a massive beneficiary on that deal. And Everbank did the financing for us. They've been JT Horner and team there have been fantastic. We've had a really good experience with them. And that's been yielding like 8+%.
Did your mentor from Seattle walk this one with you?
He did not. He did not.
But was his voice in your head a little bit talking
little bit.
about, do you like the real estate?
Absolutely.
Just buy the real estate.
Absolutely. I run everything by him. So it's funny because real estate's so local, right? Like I run everything by him. So like I looked at a deal because like in Seattle, like you have Queen Anne, Capitol Hill, Belltown are like the prime neighborhoods, right? And I found a deal in Capitol Hill and I called him up and I was like, hey, what do you think of this one? And he's like, ooh, I wouldn't buy on that side of the street. I was like, what? It's in Capitol Hill. And he's like, yeah, but that like one location is not good. And I was like, oh, like, and it's fascinating. Cause like if you were like even more detached and you're an allocator and you're like, it's in Capitol Hill, good. Demographics, good. I will buy. Like, it's amazing how local the game is. Like, and he's like, oh yeah, that place has not been good for 50 years. Don't touch that corner.
I think the term location is actually an investor created that term and the retail world abused it. Because what the investor's saying is not just Capitol Hill and not just X Street, the north side of X Street.
Correct.
Right?
Yeah.
Like this is the level of the deepness we want to get into when we actually deploy funds into a market. It's not location. Everyone wants to. No, it's not the neighborhood, not the city, not the street. Where are you specifically? Who's next door?
Yeah.
All that stuff matters.
Yeah. I mean, absolutely.
What are you going to do to this deal? So tell us, you got a good basis. You like the property.
So, yeah, it's interesting. So it hasn't all been fun roses with it.
Is it ever?
Yeah. So like often happens, right upon acquisition, we had a mass exodus of residents. They just, right? And
Your
so-
closing gift. I call that your closing gift.
Yeah, there were like a bunch of move-outs, which has been really...
Why do they do that? They're like, oh, there's a new sheriff in town. We got to get out of here.
Yeah, there was a lot of... I mean, I think...
They're going to raise our rents.
It's really interesting. So, we manage our own stuff in Portland, but I'm not planning to manage our stuff in Seattle. And we work with third-party managers in Seattle and Tacoma and a lot of stuff in Portland, too, at this moment, and then in the Bay Area as well. And it was illustrative of what really good property management looks like, because the team we've been working up with there they've been really good. And we had this huge vacancy event hit, and they were all over it. And they filled the building back up. I mean, I think we went from 95% down to 80%, back up to 98% in like the course of a month and a half. Right personnel, right team running it, doing the right thing. Months later, I go online and I Google the building, And there's a really nasty Reddit forum talking about the building. And they're like, oh, this place is the worst. The walls are paper thin, blah, blah, blah. But this manager's a creep, blah, all this kind of stuff. And then I realized that this vitriolic kind of angry stuff is directed towards the former ownership and the former live-in manager who the family had allowed to be in the building and was like making creepy
Part of the
comments
problems
to females
of
and all this kind of stuff. And I emailed my management company and I was like, hey, should we address this? And the kid who was running the building was like, oh, Arie, I saw that 3 months ago and I've already posted a full rebuttal and like let everyone know that we're running the building now. And and I was like, oh, that's
on it.
awesome, dude. Like, that's so cool. Because I feel like normally I'd be like, hey, can you deal with this? And be like, oh, of course. And then they go deal with it.
Yeah.
Like the level of proactive
Yeah.
ownership.
That's above and beyond. That's
Awesome.
good management.
Yeah,
They think like an operator.
Yeah. Well, the owner of that firm is giving this guy tickets to Augusta, so he's getting some benefit
that
from all he's done.
Is that how you reward him?
Not me. Not me. I told the boss, I was like, you got to take care of this guy.
Yeah.
He's like, I will. But so what are we going to do with it? So, we're not doing anything with it. Like we make some modest upgrades. We're like,
You got basis. You don't need to.
basis.
You going to hold it long term, or does this have like a 5-year exit?
It's long term in syndication, so 5 to 7 years.
So do you have a plan? Then you have to exit, or do you have any time where you get to sort of the fork in the road and you say, we want to hold this. We're going to take our equity off the table. The investors that want out can get out, but the rest can stay in.
I think we're in a position where I think given the basis and the fact that the loan is amortizing, we'll be in a position if we wanted to refi or pull or get people out if they want to stay out, and we'll keep the building in place.
If people want to get out in a refi, are you just buying their membership through the refi? What are the mechanics of it?
Well, we haven't done it, so I can't speak to that. I mean, we've had investors that want to get out of deals before, and then I've independently structured buyouts.
You just buy out their agreement.
We just buy them out for an agreed upon price. But I mean, on this particular, it's kind of interesting because in addition to getting the building lease back up, it's funny too. The management company would say, "Well, what's your rent that you want for the unit?" And I'd be like, "I'm not going to tell you. What do you think you can get for it?" And then they went and got the rents they thought they could get for it, and it was universally 150 to 200 a month more than we underwrote to. And then they'd be like, "Well, are you okay with us renting it for this?" And I'd be like, "Yeah, that's great because I actually underwrote to this." And they'd be like, why didn't you tell me that? And I'm like, well, because you got 200 a month more.
Yeah, we want to see what you think.
I don't want you to just use my numbers.
Because you just made me a couple $100,000, and I really appreciate that.
I'm happy with you doing that. And then, the other thing the building had an issue with was it had an undersized laundry facility. So we invested in we actually oversized the laundry facility because the unit type are large units, high rents, but they have a shared laundry facility. So our thought process was, if you're willing to spend $24,000 to $3,000 a month for a really nice unit, you better not have to wait for laundry. So let's go bigger and let's put more units in this space. So we completely upsized the laundry facility, which has been hugely well received by the residents. So yeah, we're really happy with it. That's the kind of deal we're buying right now. I mean, we're really focused on this like turn of the century. We're closing one in February in Portland, about $108,000 a unit. Pretty excited for that one too.
Mike likes to talk a lot about covered land plays. Would you consider that a covered land play? Like you talked about the location. Is that something? Would somebody ever come in and just wipe it out and build something new there?
It's interesting. So the Seattle deal, the question on these buildings is always earthquakes, right? We're due for a big one here at some point. And we run everything with earthquake insurance. But I actually had the developer group that invested in the deal tell me what they thought the land itself on that location would be worth. And the land was worth basically what we bought the building.
There you go.
Yep. And so the
Free building.
Yeah, and I don't even look at the building. It's more the price ratio to the land ratio and the income stream. And because your improvements have a different lifespan than your economic lifespan of the land. And so at some point, any big growing area of the land's going to outpace the value of the improvements.
Right.
As long as the improvements aren't too big.
Yeah. I mean, I think this land is incredibly valuable, and it's actually surrounded by brand new buildings everywhere. It's just like this one classic old property in the middle, but it's a beautiful building.
Which honestly, I prefer to do that because now you have a value, you have something different, right? Like the whole thing about success is you're unique, you're different, and when you're in those expensive historic neighborhoods, that's what the value comes from.
Yeah.
Or if you can take something old and turn it into something cool and way different with modern features, and then people really pay.
Yeah. That's probably the exit, right? At some point, I think when the financing comes back, short rates come down, bridge debt comes back into vogue, we sell it to someone that wants to do that.
Yep.
And they'll make a mint on it, but we'll do really well too.
That's exactly what I was going to say is when you're making lots of these basis plays, you don't ever have to do the value add.
Right.
Because market conditions will change and you'll sell it to a value add investor.
Yeah.
You're going to beat your metrics without doing any of that. And now you have the opportunity to roll your capital in and stack it on something else.
Exactly.
Yeah.
That's what our thought process is.
Yeah.
So, yeah.
Can you spell out your buy box for us? You said Seattle, Tacoma, Portland, Bay Area.
We're not really doing Tacoma right now.
Okay.
Tacoma's been a complex market to invest in, and we're not really doing the Bay Area right now.
So mostly Seattle, Portland.
Seattle and Portland are the focus.
But for brokers listening or anybody that's got a deal, you like the older buildings that other people aren't buying right now.
Yeah, we'll buy them. That's kind of our.
You're looking for low basis economic deals. That makes sense.
Low basis, well located. So in Portland specifically, I'm really focused on the Northwest District and Goose Hollow, kind of around. I live in the Portland Heights, so I like anything that's within like a 2-minute drive of me.
Okay.
And I've taken the mentality of like very, very hands-on. So like I like to be in the buildings. I like to meet the residents. I like to spend time with them. Retention and renewals have become, like with everyone in this business, have become a major focus for us. So like how do we make sure residents feel like they're being served by us and then be willing to pay more rent to stay in the building with us rather than leave, right? Minimize turnover. And I feel like one of the solutions to that is, as the owner, to be very like much there, right? Which I was always shy to do before. Like I never wanted to meet with residents. I didn't want them to know who I was. I wanted to kind of hide my face. We've had some interesting experiences with it. Like I went to a building that was a proper value add deal where rents had gone up, and we hosted a pizza party for the residents when we took over the management. And like I was there personally. I was like, yes, I'm the owner. I wasn't like, oh, I work with the management company. I'm the owner of the building. And it was like you'd expect. Some people were like, "Why'd you raise my rent so much? Like, I've been here since before you bought this, and rents have gone up crazily." And it's uncomfortable. But at the same time, it was like, "What problems are you having? Like, what did the prior management company not solve for you?" And they'd be like, "Well, I've had 5 maintenance requests out for months, and no one's responded to me." And I was like, "Great! Like, we're going to be here tomorrow. I'm going to have the guys come tomorrow. Everyone tell us everything. We're going to have a whole day. We're just going to do all this stuff." And they were like so appreciative. They're like, "This is amazing. Like, it's really nice to meet you. I'm not happy you raised my rent, but I've never met the owner in person before in my life. Like that's a really cool experience."
Yeah, you're talking to the level of detachment that our society designs. Like our economic system designs a level of detachment. And if you're willing to go beyond the detachment, like you said, and show your face, people don't expect it.
No, yeah. And that's why I want to own where I can go myself and be there and like see people. And like if there's a problem, I can drive a minute from my house to the property and deal with it myself or have my team go deal with it. So niche, focused, micro. But yeah, I mean, I think close in Portland, 20 plus doors.
I think you and I are the only people who want to buy in Portland right now. Close in.
Let's go. Let's do it.
When you came in, I was actually trying to finish a summary on a romantic building in Northwest.
So romantic.
You romantics.
Yeah.
I mean, he has all these like 15-minute long conversation on why you want to invest there. It's just romantic.
It's a romantic.
I just love it.
You are quantitative. You're not qualitative.
All right. We've got Arie van Gemeren here in the studio. Arie, thanks again for joining us on Deal Junkies. It's been super fun having you on the show. If somebody wants to reach out to you, let me see if I can get this right. Arie, A-R-I-E, at LombardEquitiesGroup.com.
LombardEquities.com.
LombardEquities.com.
Correct.
Okay.
Yeah.
And you are the Timeless Investor. So if somebody wants to read your articles, they can go onto Substack. They can subscribe to your newsletter. Yep. They can watch you on YouTube, all over the place. Arie, it's been great having you. Thanks for doing this. Deal Junkies, we love you. Please share us with someone you love, and we'll see you next time.